Everybody says diversify, diversify, own more than just one asset. And what happens? You end up with this. You've got a diversified portfolio and everything is going down at the same time. Now there's a mathematical term for this, and that's correlation. As in, some assets are correlated to one another. As in, when Bitcoin goes up, then a lot of altcoins go up as well, and vice versa. Now diversification is about finding assets that have very low correlation to one another. So there are certain assets that are directly competing for the same dollar. As in, if you want crypto exposure, you have to decide if you want to be in Bitcoin or in Ethereum or in certain altcoins. They tend to go up and down at the same time, so you simply just want to get the best performer. But there are also other assets that might not go up and down at the same time as Bitcoin, that might not necessarily perform as well, but that are still potentially healthy to hold in a portfolio because it balances out the overall risk, and it might still keep your overall value relatively high when one of the asset classes crashes, and then you can potentially take advantage of the low prices of that crashed asset class by selling the things that haven't crashed, again because those other things aren't correlated. And so I believe it's very important to make that distinction. You do want to have different asset classes that aren't too much correlated to one another, but you don't necessarily have to diversify within the asset class. So for example, over here, what we've got at the top is the silver price in US dollars. What we've got at the bottom is the correlation coefficient of silver to gold. Now correlation coefficients go between +1 and -1. When it's at +1, it means that the two assets move in the same direction on the same day. When it's at -1, it means they move in opposite directions. When it's at 0, it means there's no correlation whatsoever. One thing might go up, the other thing might go down. And what we can see from the correlation between silver and gold is that most of the time the coefficient tends to be somewhere between 1 and maybe 0.5. It's very rarely in negative territory. So most of the time, silver and gold tend to perform equally. I have a look at this chart. This is the S&P 500 long term. And at the bottom, we see the correlation coefficient of the S&P 500 relative to the NASDAQ 100. So that now looks at how much does the return of general stocks correlate with the return of tech stocks. And again, the correlation coefficient looks very, very similar. Or have a look at this. This is Bitcoin's correlation coefficient to Ethereum. Also, most of the time close to 1, maybe 0.5. And that then gets expressed in things like this, right? When Bitcoin goes down, then all of the cryptocurrencies go down with it. And you can't really diversify your way out of this within crypto. If you've got more than 2 or 3 assets in crypto, and if not all of your money is in echelon prime in the last week, then you would have lost. Again, had to be solely in crypto. And that's why it's so important to have other assets as well, because other assets might not have gone down in the last week. And you might consider selling some of maybe the gold or the NASDAQ 100, etc. that might have gone up. You might sell the thing that went up and you might buy the thing that went down, so you can actually take advantage of price drops. And so let's compare this, right? Let's look at cross asset class correlations. Can you really reduce risk without reducing performance too much by investing across asset classes? At the top, we've got the gold price, and at the bottom, we've got the correlation coefficient to Bitcoin. So here we are answering the question, is Bitcoin a direct competitor to gold? Does Bitcoin and gold compete for the same dollar? And the answer is no, right? Just have a look. The correlation coefficient now moves between +1 and -1. So this looks very different to the correlation coefficient between silver and gold. Bitcoin and gold isn't that correlated. So one might go up while the other goes down and vice versa. Or check this out. At the top is the long-term Bitcoin price. At the bottom is the correlation coefficient to the S&P 500. Also, it's oscillating pretty much between +1 and -1. Now there is a bit of a caveat here, and that is the long-term returns of Bitcoin to technology stocks. So when we don't look at the daily returns, when we look at the monthly returns, it appears that over the month, returns of Bitcoin and the NASDAQ 100 tend to be very similar, at least in the last 3 years or so. Will this continue? Nobody knows. We don't have that much sample size, but it's at least noteworthy. So can we diversify away from Bitcoin risk by buying tech stocks, potentially partially, potentially over the short term, as in the Nasdaq might crash one day by 10% and Bitcoin might not. This could be a potential opportunity then to buy technology stocks and sell Bitcoin. But over the longer period, right, over the months, there's the real possibility that the returns actually approach one another. Again, on a daily time frame, we don't see that correlation yet, but on a monthly time frame, we do. So what can we take from this? Not all diversification is created equal, right? You can't just diversify yourself out of Bitcoin risk by buying altcoins. Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com. But that also means that there are some investments that are directly competing for one another for the same spot in your portfolio. Again, you want to have different kinds of asset classes, but within one asset class, it's really asset A versus asset B. So the question really is, should you be buying silver or gold? Because they go up and down at the same time. What you've got over here is the silver price divided by the gold price. And just looking at this chart, to me it appears as if silver currently could be the better choice. And maybe after it has outperformed by 50% or so versus gold, it could be time again to buy back gold and to sell silver. So across asset classes, you want to own different things. Within an asset class, as in here precious metals, you can just buy one thing because silver and gold is competing for the same kind of volatility. You don't benefit holding both silver and gold. The same way you don't benefit holding CRV and ORDI and Fk'ed at the same time because they move in the same direction at the same time. You don't benefit in terms of diversification. And for silver and gold, that's the same effect. It's about buying silver or gold. And currently, I'm not an expert in precious metals, but just looking at the chart, it appears as if silver is comparatively somewhat cheap relative to gold. Or let's look at Bitcoin versus Ethereum, right? Again, two assets that are directly competing within the same asset class, cryptocurrencies. What you've got indicated over here is the merge. This is when Ethereum moved from proof of work to proof of stake. Since then, Ethereum underperformed Bitcoin by quite a bit, by almost 50%. Is Ethereum now cheap? Is it now expensive? The answer isn't that obvious because we have seen Ethereum being way cheaper in the past relative to Bitcoin. But if we zoom in a little bit, it seems like at least in the last few weeks, we've seen a sell-off in Ethereum that might not be 100% justified. So if you're just looking at the short term, you're considering to either be overweight Bitcoin or Ethereum, it might not hurt to be somewhat exposed to ETH. So I looked at precious metals, we looked at cryptocurrencies, let's have a look at stocks. Again, all of those asset classes are very lowly correlated, at least in the short term. We don't necessarily know how the correlation between tech stocks and Bitcoin will play out, but we definitely know that general stocks and tech stocks are very highly correlated. So should we buy general stocks? Should we buy the S&P 500? Should we buy tech stocks? It appears that over the decades, growth stocks are outgrowing general stocks. So this is the Nasdaq 100 divided by the S&P 500. And this peak and crash that we see over here is the dot-com bubble that burst in the year 2000. But this is a very long-term chart, right? It starts in 1985. This is almost 40 years of data. And over those 40 years, tech stocks outperformed general stocks by almost 5x. And so probably, that's my opinion, this very long-term trend will continue. Tech stocks are very likely going to continue to outperform general stocks. And there's many fundamental reasons for this, right? It's easier to scale tech stocks. It's easier to produce an additional unit of software relative to an additional unit in the traditional economy. It's easier to be spread globally across markets, etc. There's many advantages to tech versus other industries. And so when it's really an either or decision because there is a lot of correlation within the stock market, then I believe it makes sense to rather own the Nasdaq 100 ETF, to own QQQ, rather than buying, say, Disney stock or buying Coca-Cola. If you got something out of this video, feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. Feel free to, of course, also share this with your friend in case it's helpful to them. Now, if you've got Telegram, feel free to join us. The link is down below. It's 100% free. Looking very much forward to chatting with you. Cheers.